Recording in progress.
Good morning, good evening, good afternoon, and welcome to the 2020 Master Trader Program with Mark Minervini. I'm Bob Weissman, your moderator. This is day 4 of the workshop, and today's day is full curriculum day. There is no questions and answers for today. There will be time for that tomorrow. On Monday, the live trading day, which does start at 8:30 a.m. Eastern Time. We'll have the room open 30 minutes beforehand, but notice the 30 minutes starting earlier time frame. I do believe the Zoom reminder email may have reflected the 9 o'clock, but it is actually 8:30. Keep in mind, the market doesn't open until 9:30, of course, and what you're seeing pre-market is Mark's routine, which will include things along the lines of his screening. Any real money trading we'll be doing throughout the day. Also, we'll have MarketSmith representative Scott St. Clair here to review the MarketSmith software. Any questions you have about MarketSmith, who is our official sponsor, by the way, for the event, brought to you by Investors Business Daily, is going to be available and showing off the software. And you will be able to ask him questions as well. And also, as a reminder, you can send any emails to bob@minervini.com. Don't type questions into the chat box because they will be lost. As comments come in, they just get lost. As a reminder, today's event, there is a very strict no recording of any audio or video and no distribution or dissemination or sharing or posting of this on any forum, social media otherwise, but we do appreciate and have seen a ton of comments from your experience of the event. So we do love to see any of your comments and sharing of your thoughts on the workshop on your social media platform. So we have been seeing, or I have been seeing, a lot of those, and so do appreciate you guys really enjoying it. Today is what I believe is the most fun day of it. It is about 5 hours, about 5 hours and 15 minutes of curriculum. There will be breaks after each session. Today, we will be starting with risk management on page 415, the 2 sections that we are going to be passing, which will be covered tomorrow, daily routine, and putting it all together. Those pages will be reviewed and discussed tomorrow. So 404 to 414 will be tomorrow. We'll be starting with page 415. And also, just as a quick reminder, the replay of today's session will be tonight at 6 p.m. Eastern Time. The room will open 30 minutes beforehand using the same username, login credentials as you have been using for the entire workshop is what you'll use for tonight again, as well as tomorrow's live trading day. So with that said, let's get started with day 4 of the 2022 Master Trader Program, page 415, risk management. Let's get to Mark and Mark for getting started.
Okay, everyone, welcome back. 2022 Master Trader Program, Super Performance Workshop. I'm here with Mark Ritchie. We're on day 4, and you should be in the second volume of the workbook. We're going to move to we're going to the risk management section, and that's going to be on page 415. Let's make sure, Mark, you there?
I am. Can you hear me okay?
Yep, I can hear you. Great. All right. So just real quick, we talked about reference points, defining what specific entry point analysis is, how we're using all this information to come down to a very specific buy point. We went through stage analysis, the 4 stages. We want to be in stage 2, of course. We did relative charting against the market, how to spot leaders, VCP, entry points, looking for that tightening in price on the right side, going through those iterations of contractions, fundamentals, looking for earnings, sales, margins. I showed you a bunch of ways that I slice and dice that information. And then we also talked about sell rules, selling at the strength, warning signs, and so forth. Now, all that boils down to, if you don't get this next part right, risk management, and you're not operating within a framework of risk first, you can pretty much flush everything else down the toilet because it all comes down to risk management. And that's why this is a really super important section that you need to pay very close attention to. And it's going to be, it's long, it's deep. There's some areas that, you may get lost a bit, and there's other areas where you may get bored. I'm not sure, but it's all really important stuff. I want to start off with just talking about what this first slide says. Stocks are not like mutual funds. They don't have a manager. You're the manager. You have to manage the risk. If you don't manage the risk, it will manage you, and you won't like the outcome, I assure you, ultimately, at some point in time. Now, currently we're in a bear market. A lot of you can relate now that Facebook's down, 75%, and some of the biggest cap names have come under significant selling, and many of the growth stocks are down 80-90%. We talked about the 50-80 rule. This particular bear market has certainly put an exclamation point on that rule. So you can probably relate to how important it is to manage your risk, cut your losses, and so forth. So I want to start off with it. Again, some of these things I talk about in my book, you may have heard me talk about before, but it's real important that we set some expectations or some reference points here in addition to what we've already discussed. I want you to have some perspective here. The loss adjustment exercise, this is something that Larry Height, who many of you know is in Second Market Wizards book, was one of my mentors, or at least someone who influenced me. His interview in that book and his style influenced me quite a bit. I've become great friends with Larry and talk to him all the time. The way that I originally became acquainted with Larry and became friends with him is he actually called my office. He talked to Bob Weissman, called and said he was looking for Mark Minervini. Bob said, "Who is this?" He said, "Larry Height." Bob said, "Larry Height from Market Wizards?" He said, "Yeah." He says, "Okay, what can I ask what this is about?" He says, "Well, there's a page in Mark's book, and I loved it so much that I made copies of it, and I sent it to my grandchildren, and I sent it to a bunch of people in my family, and I want to talk to them about it." It was this particular topic or this exercise in my book that he was referring to. So, and I gave him a call, and we had a long discussion about this. And he did a similar early on. He had a similar experience and did a similar exercise with losses of arbitrarily cutting his losses and doing a random generator where he found that it was, if you cut your losses at a certain point, it became profitable. I also talked about this in my Market Wizards interview with Jack Schwager about randomly, setting a stop loss and even throwing darts, at a Wall Street Journal, I think I said in that interview. So real quick, just want to go over this again, because like many of you, I did not start off trading well, and I had a lot of big losses in the beginning, and it was due to looking back and studying them. It was due to holding losses and not accepting them when they were small. I did embrace the idea of loss cutting pretty early on, but I didn't do it religiously. And I'd have every now and then I'd have a 25, a 30%, sometimes even a 40 or a 50% loser. And those took this big toll on my portfolio that I didn't even realize at the time how powerful, minimizing my losses were. But I was very interested in understanding it. So what I did was, after I had a period where I wasn't trading very well for a couple of years, I was down about 12 or 13% in my portfolio. I said, it would be interesting to just see, what if I was 100% religious and I just cut every loss at an arbitrary 10%. What would that do to my performance? Would it have made much of a difference? So I went back, I took all my trades, and I made all the losses that were bigger than 10%, 10%. And I also took all the losses that were smaller than 10% and made them larger and made them 10%. So I just made a 10% cutoff, just an arbitrary number. Well, the results came back, and I would have been up over 70%, close to 80%. So I immediately thought I must have made a mistake. That obviously it couldn't be that severe from such a small change. And I ran the numbers again. Same number came back. I ran them again. Third time, same number came back. The number was correct. So then I adjusted survivorship bias, and I might have been knocked out of some names by choking them off, and I adjusted for all that, and it was about the same. It was just maybe a little bit less. It was still above 70%. I said, man, this is incredible. This is so powerful. And the light bulb went off. And that was the point at which I just drew a line in the sand. And I said, that's it. I'm drawing a line in the sand. And I'm never, ever going to let a stock, unless it gaps and there's nothing, it's out of my control. I'm never voluntarily allowing a loss to get larger than X. And I drew that line at 8%. So in this example here, this is a hypothetical example, but you can see there's 20 trades, and in the original account results before they're adjusted, you're down about 12%. The average gain is 18.4%. The average loss is 15.9. Batting average is 50-50. It's just one trade's profitable, one trade's not profitable. And it doesn't matter the order you do this in. It could be in any order. Compounding is going to work no matter what order you do it in. So now adjusting to 10%, what that did was that took that 15.9% loss and made it 10. So the only thing that was changed was taking 5% off that loss. And that is what created this result of going from minus 12 to almost 80, just under 80%. So you might want to do this if you're someone who holds losses, you've had trouble in your account, you may want to do this exercise. It could be very eye-opening when you see the power of managing the risk. And the reason why we're even starting with this, and we're going to start with a couple of slides of things that you may have heard before or concepts you may have heard before, is because we really have to pound into your head and get you to embrace the fact that this is something that can't be compromised on ever. Like, this is the whole ball of wax. This is why Mark Ritchie is Mark Ritchie, and why he's got the results he has, why I have the results I have, why Paul Tudor Jones has his results, Bill O'Neill. You can name any trader that's a great trader, a champion trader, a legendary trader, and you're going to see that across the board, the thing that they really have in common is the managing the risk. That's the part that they focus on first. And everything I do in the market starts with a risk first approach. I always look at risk first. And if the risk isn't acceptable, I don't take the trade no matter what the potential reward is. Now, this is certainly a chart that many of you have seen before, and talking about losses work against you geometrically. Okay, some of you may have not understood this or been seeing this type of diagram, but when you have a loss and one of the reasons why we want the losses to be small is because mathematically, after you get above a certain point, the math starts to work against you, because losses work geometrically against you. What that means is that the larger the loss, the more work it takes to recoup the loss. So when you're down 5%, it only takes a 5.26% gain to get even. 10% takes an 11. It's about apples to apples. You get down 20, it now takes a 25% gain to get even. You get down 50, you have to double now. It has to be a 100% gain. Stock goes from 100 to 50. For it to go from 50 to 100, it has to double. So now it's working way against you. And God forbid you're down 90%, which some stocks are down that now. If you held it down, it's got to go up 900%, or your portfolio would have to go up 900% just to get back to break even. And I'm sure you haven't had that many stocks that went up 900%, right? Certainly not something that you can do regularly. So there's three things that you have to right up front know about losses. Number one, you're going to have lots of them. All right, trading is about having lots of losses and taking small losses. You are not going to be correct all the time. As a matter of fact, you're going to be correct probably half the time. Mark, you've had an incredible track record and your drawdowns have been amazing. How often are you right versus wrong? What's your percentage of profitable trades?
Yeah, I'm right. Yeah, I'm right about just under 40%. So I'm wrong. I'm wrong more than I'm right. And just to hammer home a couple of points, one question I get all the time is, what did your dad teach you about markets? And if there's one thing he kind of pounded in me in the same way Mark and I are going to try and pound this in everybody here, is that losses are a part of the game. And if you don't learn how to take them when they're small, they will get bigger. And if anybody's figured out a way how to avoid a big loss rather than taking it when it's small, please tell me, because I'm all ears. There's no other way to do it. And just one quick story, after the first master trader program I went to, won the triple digit challenge. Afterward, I was speaking with another gentleman who had attended the first one with me. I think we'd sat, a couple of chairs apart, and we were just talking. And I said, well, how's your performance been? Because the market had been a good period, obviously. I was up over triple digits, and he said, I haven't done very well. And I said, well, why? And he goes, I just held on to a few too many losses. It doesn't take holding too many, or just this one time type trades, as Mark will get into, to really destroy what is otherwise a great strategy and approach and an equity curve.
Yes, and we're going to dig into the math, and we're going to show you the math behind this, and really, it's going to be quite eye-opening. So, as Mark said, if you can, 40 years of doing this, I haven't found another way to protect myself from a large loss other than taking a small loss before it becomes a large loss. And so that's really the only protection that you have. I mean, you could buy puts and hedge and all these other things, but that's adding risk. You could lose on both. So the main thing is, you got to remember, you're going to have losses. Losses work geometrically against you, so you can't let them get large. The only way to avoid a large loss is to take a small loss. Now, not only are losses important just mathematically because they work against you geometrically, but this is all about everything that you do as a speculator, as a stock trader, as an investor, is based on risk versus reward. So, for instance, and this goes back to the one of the number one rules that I have, and that is to always be getting odds on your money. And the real thing to understand about the market is that it's not like poker or craps or blackjack where the odds are fixed. You can't really change the odds. You can only exploit them, or maximize your chances by playing correctly. But the odds are the odds. In the market, you don't really just get odds. Like, you don't know the odds, so you've got to make your odds. The way you make your odds is by controlling your risk. One of the few things that you have direct control over in relation to your reward, your potential reward. We're going to talk more about this and how you measure that and so forth. But think of it this way. You've got two traders, right? You got trader A. He buys a stock at the same stock, same spot. Or same type of stock setup, let's call it. And stock comes out, meets his criteria. We talked about VCP, breaks out of a VCP, turns around, goes down 20%, and then turns up and goes up 20%. He sells it, takes a 20% profit. Trader B buys the same type of situation, breaking out of the VCP, sets a stop at 5%. Stock turns down maybe 4%, doesn't hit that 5%, goes up 20%. Didn't allow it to go down, more to that 5%. And if it went down to 5%, would have taken the loss at that 5%. So now, how we operate with trading is we work with what we call R's. R's are a multiple of your risk. So trader A has got even money, right? He risked 20% to get 20%. So if you were right, let's say Mark just said he's right less than 40% of the time, about 40% of the time. Let's call it 50. All right, that's what most traders doing this that are good fall around 40-50%. So let's call it 50. Well, if I give you a coin, you flip it and you get $1 on heads or $20 on heads, and you lose $20 on tails, it's a 50-50 proposition. You're not making any money, right? So you got to get odds. You got to get odds on your money. But if you're risking $5 and then when it lands on heads, you get $20. Well, now being 50% correct will yield you a fortune. Matter of fact, being 35 or 40% correct, you would make money. So that's, you always have to think in terms of odds. So here's just a overlay over a stock chart where trader A buys, just breaking out of a chart. So maybe it's just started into a stage 2 uptrend. Everything's going to be applied to what we already previously talked about. And now that stock runs up from there, doesn't hit that 5%. If it does hit the 5%, he's out at 5%. But if he's exposing himself to stocks with the potential to go up multiples of that, well, if he captured that 50%, took that 5% risk, he just made 10 R's, got 10 times the money that he risked. Now, not all gains are created equal. The outcome, it doesn't justify the way you got there. You have to know, how did you get to your result? Because trader B, you've got some traders that buy stocks, they hold them down, they hold the stock down 60% and then sell it up 20%. They actually have an inverse risk reward relationship. But let's just say in this instance, this trader B buys it, he holds it down 50%, then the stock goes back up and he sells it up 50%. Well, again, they both made 50%, but I can assure you over the long term, trader A is going to make much, much more money, and trader B is going to get in a lot of trouble someday, because trader B is only getting even money. Trader A is getting a multiple. All right, right. In this case, 10 to 1, but let's just even say on average, it was 2 or 3 to 1. So they're getting odds on their money and keeping the losses small. Who's to say that that 50% decline is going to turn into a 60 or 70, like we've recently seen in Facebook and many of these growth stocks in this bear market? That's eventually going to happen. So it's a certainty at some point. So now, the whole point of this is that the result does not justify the means. And this is one of the ways that I try to illustrate this point. Think of two people on the side of a road, right? And your goal is to make it to the other side safely. So the first person closes their eyes, plugs their ears, runs into heavy traffic, and makes it to the other side. The other person looks carefully both ways, listens carefully, goes across a lightly trafficked road, and gets hit by a car, gets killed by a car. Now, who made the smart decision, right? The first person, I guess, got lucky getting across there, right? But here's the real question. What if I would say, I want you to bet on which person would make it to the other side, and it's going to happen over 100 times. They're going to do it 100 times. Wouldn't you feel that there's a near certainty that the person who's looking carefully is going to make it across more times than the person who is closing their eyes and closing their ears? So that on that any one event, that does not justify, just because he made it safely, doesn't mean that he did a smart thing and made a smart move. Well, the key to remember is you're not going to make just one trade. So the probabilities are going to eventually, they're going to surface, and everything's going to work out mathematically. If you're in low probability situations, if you're not getting odds on your money and you're laying odds, well, you're going to lose money. You have no edge. So you have to have an edge, and you have to always realize that it's over time. It's over many trades.
Mark, I just want to add,
Yep.
That's something I think, this is something I ask myself all the time. What if I did this 1,000 times? And I think if you're new at this, especially, you want to be asking yourself this, because where we're going is eventually it's these stats and the math is going to work its way into your actual decision making and into your actual trading. That's where Mark's taken us here. But the idea being, okay, if I ask myself if I do this 1,000 times, it's going to keep me from holding just one loss. It's going to keep me from chasing extended stocks or buying, sloppy breakouts. Because if I do this 1,000 times, I realize I'm not going to be ahead where I want to. It's going to help me continue to be more and more and more refined in my selection criteria.
I'm going to give you a bunch of examples, metaphors, and so forth, and then I'm going to show you a lot of math, a lot of statistics, and then all this is going to culminate to a point where I'm going to change the way you think permanently. I promise you that after this section, you will never look at a trade. You'll never trade the same ever again, psychologically and hopefully physically. That it'll translate that you'll be using this stuff, and you'll let this make its way into your trading. But I assure your thinking will be transformed. So, but I've got to give you a lot of different ways to look at this and make a lot of examples. So bear with me. I'm going to get you there. One of the reasons that we want to get odds on our money is because what it does is it actually builds in a protection mechanism by what I call building in failure. So in this table right here, think of it this way. If you're getting even money, right, and you're 50-50, well, then it's break even, right? You get $1, you lose $1, you're 50-50, it's break even. Minus commission, you would lose. But if you're laying odds, all right, you're giving laying 2 to 1. Well, now just to break even, you would have to be right 67% of the time. If you're laying 3 to 1, so let's say your average gain is 5%, your average loss is 15, you're laying 3 to 1, you'd have to be right 75% just to break even. Right? You don't even start making money until you're above 75% batting average. But let's look at it the other way now. Let's say we're getting 2 to 1, right? We cut our loss at 5% and our average gain is 10%. Now we could be wrong 67% of the time. We only have to be right 33% of the time, 1 out of 3 times, and we're still not losing any money. We're not getting into any trouble. And if you move it to 3 to 1, let's say you were getting 15% on your gains on average, and you're keeping that loss at 5%, you're right just 50% of the time. You can be wrong now 75% of the time, and you're not losing any money. You're not getting into any trouble. Above 25% correct, you're making money. So imagine if you're 50 or if you're 60 or 70, you'd be printing money. So the whole concept is to always get odds on your money. Always get odds on your money and build in as much failure as you possibly can into the system. This is the opposite of what a lot of people not only do in their system, or when they build a system, they're looking for profitability, the percentage profitable trades, but also psychologically. People don't like to lose. Just taking losses is difficult, but when you look at it this way, you start to realize that small losses and building that failure into your system gives you a lot of protection, and you look at it in a whole different way. Now, another thing that we have to start off with is to understand what is it that you control and what is it that you don't control, because you only control a few things, right? You control what you buy, you control when you buy it, how much you buy, and when you sell. Those are the 4 things that you control. What you don't control are pretty big things, all right? How much the stock goes up. Once you buy it, whether it goes up or not, or how much it goes up, is completely out of your control. And how often that you win versus how often you lose, whether the stock becomes profitable or not, once again, it's out of your control whether that stock becomes profitable or not. So how do you gain control in an environment of such uncertainty? How do you gain control? By not relying upon it, by not relying upon those things too much, and really relying upon what you do control, and the things that you don't control, you want to remove your reliance on them. And that's what we call building in failure. When you're not relying upon that high batting average and being right 80% of the time. I have a friend, as a matter of fact, he's in one of the Market Wizards books, sort of a legendary trader, and his risk reward is inverse. Right? He has a very high batting average. He's right about 80% of the time, but his average gain is much smaller than his average loss. He did well for a number of years, but when that edge was lost, when he had a couple tough times where the batting average came down, he blew up. He had a, when I say blew up, I'm talking about, maybe not bankrupt into zero, but a huge decline, a big giant drawdown that was very damaging. And that's because when you rely upon that high profitability, or that high batting average, when you lose that edge, it's much more damaging than if you lose your edge in the risk reward ratio and you build in that failure. I'm going to show you some math here and show you how that works. So again, just 2 hypothetical traders. Trader A has got an average gain of 15%, an average loss of 5%, right? So that's 3 to 1. Right, that's getting 3 times your money. Call it $15 on heads, $5 on tails. But this time the coin's bent a little bit, right? The batting average is only 40%. So at 40%, that means that's still a 2 to 1 trader. So if you were 10% gain, 5% loss, and you were 50%, obviously 10 divided into 5 would be 2 to 1, right? Well, if you would take 15 divided into 5, it's 3 to 1. But now we've got to adjust it for the 40% batting average, right? We're only right 4 out of 10 times. That also is a 2 to 1 trader. Like you're net a 2 to 1 trader. And that's what we call the adjusted win-loss ratio. It's adjusted for batting average. So bottom line, you take that trader and he does 10 trades. He's got a 28% return on investment. That's what that would compound out to. All right, let's take the other trader that's sort of like my friend, where his loss is larger than his gain. In this case, we're gonna make it a 2 to 1, right? 2-to-1 loss versus gain, which would be a 0.50 if you divided the gain by the loss. But we're going to take the batting average way up, 80%. This trader is right 8 out of 10 times. Well, it's still a 2-to-1. And if he did 10 trades, you're still getting about 28%. So you might say, well, what's the difference? If you're still going to get there, well, there's a big difference, because at some point, your edge is going to be pressured. You're going to lose your edge. And there's going to be times where your strategy doesn't work very well. We'll talk about that later and why that's important. That's actually a good thing. So what we're going to do now is we're going to sort of clip the wings of the edge of these two traders. So we're going to just cut their edge in half. Basically, trader A, his edge is not in the batting average, because his batting average is below 50. He's actually losing more than he's winning. But the edge is in the risk-reward relationship. So we're going to take that risk-reward relationship down from a 2-to-1, or actually, I'm sorry, from a 3-to-1 down to a 1.5-to-1 with the same 40% batting average. Trader B, we're going to keep it like it was, although we're going to now take the batting average and we're going to cut it down and cut that edge in half and take it down to 40%. Now look at the two traders, right? Trader A is about flat, loses 2%. Trader when losing half of the edge. Trader B loses 50%. And this is where, like I said before, I know people that have blown up their accounts when they've got that high batting average, but the batting average fails. So let's say that maybe you feel I'm being a little unfair on Trader B. Okay. So what I'm going to do this time is I'm going to penalize Trader A even more, and I'm going to penalize Trader B less. So we're going to still cut the edge in half, but now we're going to take the batting average on Trader A and make it 30%. Now he's only making a profitable trade 3 times out of 10. So in 10 trades, he would lose 13% return on investment. All right. Certainly, I wouldn't be happy with that. And that's we're not looking to go into the negative, but at some point, yes, you might have this type of result, and we want to build in as much failure as possible. So when things go wrong, we're going to minimize that downside. Well, Trader B, we're gonna cut that edge only down by a quarter, just from 80 to 60, which I can assure you that if you're relying upon an 80% batting average, you will have periods where you're running at 60 and probably even 50 or 40 or less. So now, again, penalizing Trader B less and penalizing Trader A more, still Trader A outperforms Trader B by quite a margin. And instead of 13% decline, you're down 20% with 10 trades. Okay, so let's take it a little bit further here. All right, let's try another permutation. So now we're gonna take the average gain and we're gonna actually increase it. Okay, and we're gonna bring it back to that original 40% batting average that we talked about before, because that's more realistic. Where you lose your edge, you're gonna lose your edge by half, and we're gonna cut the edge in half for Trader A, but also keep that batting average down to that low 30%. Still, Trader A loses 13%, Trader B loses 34%. So you can play with these numbers. We've looked at them ad nauseum in every kind of way you can think of, but a high batting average is not where. Now, no, don't get me wrong. If you love to keep your reward to risk high and have a high batting average, that's the best of both worlds. And at some point, you will run at a high batting average and you'll be managing that risk to reward, and that's where you'll make a ton of money. But there's going to inevitably be times where things get tough, and you've got to build that into your system. This is what I call building failure into the system. And that's why I would rather have a strategy that I made money being right 1 out of 10 times. I'd rather lose 9 out of 10 times and be able to not lose money than a strategy that had a 90% probability of winning. Most people would say, oh, I want the 90% probability. No, I want the one that I don't lose any money at 90% being wrong, because I only got to be right 20% of the time, 30% of the time, and I'm making great money. And if 40 or 50, I'm printing money. So building in failure, Mark, in your, and I could just say also in my own experience, when things are going, when we're in a bear market and trades aren't going very well, I might be down in the 20s to 30s, my batting average. But when the market's going really well, I'm sometimes in the 60s, and even I run in the 70s for short periods of time. What's your range, Mark, as far as when you're doing well, what could we expect for a batting average on the upper end and on the lower end when things aren't going so well?
Yeah, very similar. And this year's been a good example. My batting average has been in the 20s. But because I've built in that failure, I'm keeping the losses, contained. It's the drawdown differential, between these two, because tough times are inevitable. So what we're really saying is, when the tough time comes, how bad do you want to be down? And relying on the higher win rate is often a recipe for much bigger drawdowns. And the other thing I would just add is, I think often folks that are new to markets, they don't like how it feels to be wrong. I mean, let's be honest, it's not always fun taking losses. You can be disciplined about taking losses, and you don't have to enjoy it. But it's just part of the business, where folks often think, well, if I can just find a strategy where I'm right all the time, and that will fix the problem. And what I'm hoping, and I know Mark is trying to hammer home, is that's the opposite of what you really want to do. You want to build in enough failure to where, things can be running poorly, and you're barely down. So then when they inevitably are good, you're into new high ground in terms of your account, just like a good stock, and making money with relative ease.
Yes, and as Mark said, and that was where I was going earlier, is that most traders and investors have a very hard time with a strategy that has a low batting average, because it feels like you're losing a lot, and it's the number of occasions of losing versus winning that's psychologically difficult to deal with. And what we're trying to do here is get you into a mindset that you start to see the math behind this, and when it starts to make sense and you understand, then you start embracing losses as long as they're small. You realize that small losses are part of the business, and the risk is being paid for by the reward. And by building in that failure, you're actually bulletproofing your strategy. You're creating this protection of having a drawdown. Let me move on here. Basic rule that you have to always remember is that losses are a function of expected gain. So, for instance, if you're a day trader, your expected gain might be, 1 or 2%. You're scalping, right? So your losses are going to have to be much smaller than someone who's swing trading and maybe has a 10, 12, 15% gain normally. And depending on what your batting average is, of course. So the holy grail of trading, okay, or any speculation, you've got to make, even any business, when you're in business, you buy merchandise and you've got to sell it for more than you paid, right? It's that simple. You still have to manage the risk reward relationship. Stock trading is no different than any other business. The stocks are the merchandise, you're buying them, and in the hopes that they go up higher, more than you paid, and you've got to manage the downside. And I think Bill O'Neill used the dress, the red, the blue, the yellow dresses. A retailer buys blue dresses, red dresses, and yellow dresses, and the yellow dresses aren't selling, and the red dresses are selling great, and the blue dresses are okay. What do? They put the yellow dresses on the clearance rack, they mark them down, they get rid of them, they buy more of the dresses that are selling. So that's how you have to think of your portfolio. So the holy grail, the thing that you have to always be managing and thinking in terms of, is your average gain times the percentage of winning trades divided by your average loss times the percentage of losing trades. That gives you your adjusted win-loss ratio. That goes back to what I was talking about previously, where 15 divided by 5 is 3-1, but netted out for 40% batting averages is 2-1. That's the formula. That's the holy grail formula, right? So taking these, what I call the trading triangle, the 3 elements of that formula would be your average gain, your average loss, and your batting average. And this is what creates your edge. This is what creates the edge, where if you have your average gain is larger than your average loss, or even in the instance of trader B, where the average loss was larger than the average gain, but the batting average was high, right? That would give you an edge. And that may be, that may be the route that you end up going. But as I just pointed out, if we can get the lower batting average and maintain our edge in the risk reward relationship, well, then we build in a lot of failure. And when that batting average improves, it turbocharges it, right? So let me show you a few things that.
Mark, just to highlight that last
go ahead.
slide too, I just want to, if you're new, I want to encourage you to think in these terms. And there's been a lot of traders over the years now who've reached out to me. And one of the first questions I usually ask them is, well, what's your average gain? What's your average loss? And what's your batting average? And usually they don't know them at all. And we'll get to that, I think, in the post-analysis section, if I'm not correct, Mark. But the idea in terms of just, you want to make this almost an axiomatic part of the way you think, to again, letting these numbers and the math then eventually work into your decisions, which is where we're going next.
Right. And that is to know the truth about your trading. That's what Mark is saying. That's where we're going next, is the first step is to know the truth about your trading. Get your head out of the sand and take a look at your numbers and find out where you're at. That's the very first step, to see where you currently are at. And that's going to come in the form of, what you want to look at is your average gain, your average loss, your percentage of profitable trades. You also want to look at your largest gain. I like looking at my largest gain and my largest losing trade in any 1 month, closed trades. And then I look at what my time that I held on average, my winners, versus the time that I held my losers on average. Okay. And I plot those monthly. This is something you can do in a spreadsheet. You can build your own Excel spreadsheet. We actually have a program that does this for you. You enter your trades and it spits it out and slices and dices. It's called Trading Logger on our MPA platform. But this is what I refer to as the instrument panel. So it's like if you were flying a plane, you've got all these instruments, right? The horizon, your speed, your altitude, those all have to be in a certain relation, or the plane is going to crash. The plane is flying sideways or upside down. So these numbers allow you to assess if you're flying the plane upright. So let me tell you how you would even analyze these numbers. And the reason why we're again, I'm going to go over all this math with you and keep circling back to this, is because we're going to try to get you to where, or we're going to get you there. We're going to get you to where you're thinking in terms of this math and these spreadsheets, and they're going to make their way into your trading. The next time you make a trade, all this math is going to be in the back of your head, and it's going to help you make better trades and better decisions. And I'll show you that in just a little bit, how we're going to get there. So first thing is average gain, average loss. And if you plot these monthly, not only do they tell you how well, during the month you've managed your losses versus your gains, they also give you good information as far as how good the market is. I mean, if you're seeing that your average gains are really small and your average losses, you've got a lot of them, your batting average is low, it usually means that the market's not too good, or you haven't, followed your discipline very well. It can only be one or the other. So